If you've been wondering how interest rates could have an impact on you, I am excited for this video because I'm actually going to break down a case study and show you something really, really special that I figured out. I did a video on survivorship life insurance. So if you haven't watched that video, take a minute, pause, go watch that video, and then come back. Because in this video, I'm going to break down a case study that is absolutely amazing and I'm really excited to share with you. So interest rates have had a massive impact on my life. I'm in a space where I'm a life insurance agent. I use a lot of annuities, a lot of life insurance, a lot of long-term care, hybrids, all kinds of different insurance products. And interest rates have had a massive impact on my business and what I can offer. I've been doing this at this point now for going on 12 years. And I just worked through a decade of low interest rates where we had interest rates so low. I mean, I'll tell you a story. In 2015, we put an advertisement in the Arizona Republic for an annuity that paid 1%. And people were calling and coming in to buy an annuity that paid 1%. It was a 1-year annuity that paid 1%. And we did a lot of that. People were excited about it because if you remember back then, interest rates were so low at the bank that just getting 1% for 1 year was like a big deal. It was exciting. I mean, it's just unbelievable to me to see where we are now because the interest rates are so much higher. And what's interesting about the interest rates right now is they've gone up higher than this in the past. They've never gone up this much this fast. So the insurance companies have caught up and they've put together some products that are really, really cool. Two of those products that I want to talk about, not specific companies and not specific products, but just overall types of insurance are the joint lifetime income annuity rider paired with the survivorship life insurance policy. And I just recently got the privilege of helping somebody in their 70s, and here's what I found out. They had approximately $500,000. Now, they had a lot more money than that, but this is just what they had that they wanted to create something with. And so with this $500,000, they were able to put it into a joint lifetime income annuity. And what that vehicle does is it basically says, okay, we're going to put the money in, and then it's going to immediately, within 30 days, start making payments to the two clients, and it's going to pay them for as long as either one of them is alive. So even when the annuity runs out of money, it's still going to pay them the income. That's the lifetime income rider portion, and it's set up as a joint life designation, which means that you have a husband and a wife, and it's going to pay for as long as either one lives. So let's say in 10 years, the husband who's 72 passes away, the wife is now 82, and let's say she lives another 10 years, it's going to keep paying out for as long as she lives. So that income is going to be secure for both of them. That's important. The second thing we did was we went and said, okay, well, who's providing the most death benefit for what's called an SGUL, a Guaranteed Survivorship Universal Life Insurance Policy. So an SGUL is basically what's called a survivorship policy, which I talked about in my last video. And it's going to be able to provide something similar, but on the other end from the joint lifetime income annuity. What it says is, okay, we need a payment every year, and as long as we get that premium payment, we're going to provide a death benefit guaranteed to a certain age by the company. So again, we picked 105. So again, you have joint lifetime income annuity, you have survivorship life insurance policy. Now here's what gets cool. The joint lifetime income annuity we picked had a 9% payout day one. Now let me stop there. That's not 9% interest. That's not 9% earnings. That's not 9% off the top. That means that with their $500,000, it's going to kick off $45,000 a year for as long as either one of them lives. Now, here's what's really cool. The survivorship life insurance policy, if we take that $45,000 and put it into the survivorship policy, that survivorship policy is going to buy approximately $2 million of coverage that's guaranteed until age 105. Now, what that means is that they pay on it past 105 and they live longer, they have to put in more premium or the policy will lapse. So they get to pick their guarantee age. They were comfortable with 105 based on the family history and what they felt with their current health and what the company provided them for an offer. But what's really amazing about that is if you think about it, okay, you have somebody in their 70s. Where else could they put that money where they're ultimately going to get $2 million tax-free for their family? I don't really know anywhere else they could do that. But here's what gets crazy. If they wanted to, instead of building a big legacy, they could actually say, okay, wait, we don't want to put the whole annuity payment in there. And again, there's going to be taxes that need to be taken care of. So putting the whole thing in doesn't really make a lot of sense for them anyway. They said, what if we shrink that down to approximately 2% of the annuity payment, and that goes in. Well, guess what that did? That replaced the $500,000. So you have an annuity that's going to start paying out 9% a year. Well, it doesn't take very long for that annuity to run out of money. Now, just because it runs out of money, it doesn't run out of income. So you go, okay, well, yeah, Daniel, that's great. They got a 9% payout from their annuity, but in like 11 years, they're out of money. So what the heck? There's nothing left over for the family. They're just getting an income stream. True. But if you're able to put some of that money into the survivorship life insurance policy, it replaces that $500,000 tax-free. And guess what they get to do with the other 7%? They get to keep it for income. So how cool is it that you have somebody in their 70s that can say, okay, we're going to get 7% payout for our lives, but then we're also going to replace all of that money to completely tax-free for our family, basically not keeping the principal intact, because remember, they're spending through the principal, but replacing the principal. So as if it's intact when they pass away for their family, and that money will be there. So again, it's not a scenario where it's like, a bank CD where they're getting 7% and they have their whole $500,000. That's the dream scenario, by the way. Everybody always seems to want that, right? They want their interest, they want off the top, they want their principal, they want it all. Everybody wants everything, which makes sense. I want everything. But in this scenario, they're able to create high cash flow that the annuity company will provide based on their life, based on the guarantees from the annuity illustration, and then based on the guarantees on the life insurance illustration, replace all that money at the end. It's a phenomenal, amazing opportunity that's just been born from these interest rates. And I think it's just absolutely so cool for the right family, for the right circumstance, for the right needs. It just absolutely blows my mind what you can do when you can combine products together to get a better result. So I think that using that combination could be really powerful, and I think it's really exciting. So again, if you haven't watched the video on survivorship life insurance, take a minute, click the link right over here, watch that video. I hope you enjoyed. If you have any questions, please feel free to comment.